Hi, I'd like to spend some time now talking about asset impairment in the context of cash generating units. The complication as you move to cash generating units is that because it has multiple assets, there is going to be the requirement to allocate the impairment across the various assets which are subject to impairment. To demonstrate this, I'm going to adopt the example of a simple firm with a balance sheet, and it's a firm which has just one cash generating unit and there are no corporate assets. That makes life much simpler. Also, my firm is going to have no liabilities. Once again, it's a simplification. So what you can see here is I have a balance sheet which comprises cash, accounts receivable, inventory, property, plant, equipment, and goodwill. Now, please note that the cash and accounts receivable are financial instruments, and so the valuation of those assets will be addressed there. Inventory is subject to an inventory standard, and the impact of AASB 136 is applied to property, plant, equipment, and to goodwill. What we can see here is that we have assets which have a total value of $925,000. Impairment would need to be considered because there is goodwill in this cash generating unit, and it would need to be done annually. And if there wasn't goodwill, it would need to be done if there was an indicator of impairment. Irrespective of whether we're doing it because there's goodwill or there's an indicator of impairment, we have calculated the recoverable amount. It's $750,000. And what we can see here is we need to recognise impairments or write-downs of assets in the total of $175,000. What we need to recognise is there are some standards that AASB 136 IAS 36 does not apply to. For example, accounts receivables are a financial asset, and that would be accounted for as a financial asset, and its value would be reduced by $5,000. Inventory is accounted for in terms of accounting for inventories, IS2, AASB 102, and that would be recorded at the lower of net realisable value or cost, and so it would have the value reduced by $20,000, and that would leave an amount of $150,000 to be accounted for in terms of IS 36, AASB 136. When you have a cash generating unit which has multiple assets, then you need to have some basis for allocating that impairment. In the first instance, impairment is allocated to goodwill, and that would be fully impaired. So there's goodwill with a balance of $25,000, and the first $25,000 of impairment would be allocated to goodwill. That leaves a residual of $125,000 to be allocated to the remaining assets subject to impairment of assets. In this particular case, I have three assets, imaginatively labelled property, plant, equipment 1, 2, and 3, and the respective values of these assets are $100,000, $125,000, and $225,000. And each of the assets represents 22%, 28%, and 50% of the book value of property, plant, and equipment. The standard requires that you allocate proportionally the impairment to each of the assets in proportion to their relative book values. So in this particular case, because asset 1 represents 22% of book value, we'd allocate 22% of the impairment to asset 1. So $27,778. And you repeat that for assets 2 and 3, and you can see that it results in an allocation of $125,000. And we allocate and we calculate the revised book values. Now, this is subject to constraint. A constraint is that you can't reduce an asset value below the fair value of the individual asset. Let's imagine that property, plant, equipment asset number 3 is land, and the land has a fair value of more than $225,000. In that case, you're not going to be able to allocate any of the impairment to that individual asset, so the asset will still be carried forward at $225,000. And the $62,500 that was allocated to the land, PPE 3, would have to be allocated instead to assets 1 and 2. Once again, it would be allocated on the basis of their relative book values. So what we can see here is we have an allocation process. In terms of what the accounting looks like, well, we can't forget about the reduction in the value of the accounts receivable or the inventory. These are undertaken in accordance with accounting for financial assets and accounting for inventories. And then it comes down to recognising the impairment expense of $150,000, and you can see that we recognise an accumulated impairment against the goodwill, and we have the allocation of the impairment to the respective assets 1, 2 and 3.